In my last video, I talked about how to act like the bank as an alternate method of real estate investing to owning rentals. Today, I'm going to walk you through a real private money deal I just completed in Columbus, North Carolina. Exact numbers, structure, and what I liked and what I didn't like, and why this strategy fits my life as someone with a demanding W-2 job. If you've ever thought, I want real estate returns without managing tenants, this is for you. If you're new here, hi, I'm Andrea. I'm a pharmacist with a corporate job, and I invest in real estate on the side. Private money lending is exactly what it sounds like. Instead of a flipper or investor going to a traditional bank like Wells Fargo or Bank of America, they borrow from individuals like you and me. You become the bank. You agree on the interest rate, the term. If it's a fix and flip, it's usually short, like 6 to 12 months, the collateral, typically the property itself, and whether the payments are monthly or deferred. Most private money loans are short-term loans for flips. This is not a 30-year mortgage. It's typically under a year. You can fund these loans with cash, like from your checking account, with business funds, or through self-directed retirement accounts, which is what I did on this deal. So let's talk numbers. As a refresher, this deal was in Columbus, North Carolina. The property itself was purchased in July 2025 for $125,000, significantly below as-is value. That deep discount is the only reason the deal worked as it did. Between my partner Liz and I, we funded the full purchase price through our self-directed retirement accounts, and I also funded the rehab budget through my self-directed retirement account. The rehab budget was projected at $85,000. But here's what's interesting. They only ended up requesting $34,000 of that rehab budget. That tells me they managed the project well, they didn't over-improve, and they stayed conservative. This property was listed at the end of December, and it closed in early February of 2026 for $335,000. So let's zoom out for a second. The purchase was $125,000, the rehab requested was $34,000, and the exit was $335,000. There is plenty of room for profit, and that margin really protects me as a lender. Liz and I each received 12% annualized on the capital that we funded. Now here's the difference between this deal and my last one. This one did not have monthly payments. Instead, the interest accrued, and I received a lump sum payment at closing. The borrowers were still required to provide monthly project updates, progress photos, and communication. So even though they weren't making payments, they still had reporting requirements to avoid default. Personally, I realized I actually prefer monthly payments. Why? Because it creates consistency, it forces those regular touch points, and it just feels psychologically safer. But since this deal was inside my retirement account, it didn't really matter from a cash flow perspective for me personally. Now, if I were living off this income, I would definitely structure it differently. This deal only worked because it was purchased at a deep discount. There was a strong spread between purchase and after repair value. It was short term, and the borrowers were experienced. Private lending is not about chasing the highest rate. It's about margin, asset protection, borrower quality, and conservative underwriting. Remember, no one cares about your money like you do. You're not obligated to fund every deal that comes across your desk. That probably wasn't a deal anyway. So if you're a high-income W-2 professional like I am, and you don't want to manage tenants, or you don't want late-night maintenance calls, you travel a lot, or you just want more passive exposure to real estate, private money lending can be a powerful strategy. It's how I stay in the game without adding operational complexity to my life. And because this one was funded through my retirement account, it allowed my retirement money to work harder than it would sitting in traditional market vehicles. So some big takeaways from this deal for me. I prefer monthly payments. That's really nice. I feel like seeing it come into my account, and this wasn't that. Deep discounts can protect lenders, and short-term loans can produce strong returns quickly. The structure matters more than the rate. And most importantly, you don't have to own 50 rental properties to build wealth in real estate. Sometimes you need to just act like the bank. So if you want to see more breakdowns like this, real numbers, real deals, just make sure you're subscribed. And if you're a W-2 professional wondering whether private money lending fits your life, drop a comment below. I'll see you in the next one.